Are you wondering how to make money through stocks and shares? In this video, I'm going to be discussing exactly how to make money from this investing method and some simple to follow strategies that you can use to maximize your returns, minimize risk, and have an overall better understanding of the companies that you'll be putting your money into. Welcome back to Financial Knowledge, where I bring weekly investing and finance related advice. If you're new here, make sure to subscribe to keep updated with future content. Investing in stocks is one of the most reliable and consistent ways to make money. So that you can get the most from your investing, I'll be sharing my top 3 simple strategies to identify great businesses that also make great investments. As always, I'll leave timestamps and links for everything that I mentioned in this video you can find down below in the description box. Essentially, the way you make money in the stock market is by investing in a company, and then as that company grows, so does its corresponding share price. If you were to invest $100 into a company with a share price of $1,000, and then the share price rises by 20%, so from $1,000 to $1,100, your initial investment of $100 would also increase by 10%. So it would go from $100 to $110. That's really the way you make money in the stock market, investing in a company, and then as the company grows and the share price grows, so does your investment. In a nutshell, what you have to do in order to make a good investment is select a strong business that will stand the test of time and will consistently grow and develop into the future. I'll just jump into a few strategies that you can use to make sure you pick profitable companies that will ultimately make a good investment as well. The first one being is selecting the right business. You're essentially looking for businesses that will stand the test of time. They have a long-term future growth potential. So you can quickly identify these types of companies by screening some numerical data that you can find on the internet. I like to use a website called QuickFS that has a lot of detailed financial information about a business. The main 3 values that I look for are ROI, revenue, and EPS. So just to give you an idea of what these numbers mean, ROI is return on investment. It's essentially how well can the company reinvest the money that it has to grow and develop the business. This gives you a good indication of how well the company can manage its funds, and if it can maintain a good ROI for itself, it can maintain a good ROI for investors as well. Revenue is how well the company can consistently grow its income, and looking at a long-term trend for this and seeing how well it's been developing over time is a good indication of the long-term strength that the company has. And EPS is essentially the percentage growth of the share price that the company's had as well. I like all of these figures to be at least 15% and consistently growing on a year-to-year basis. These are all readily available on QuickFS. I'll leave the website linked in the description box below. Pop in QuickFS into Google, type in the ticker symbol for the particular company you're wanting to look at. In this case, we're going to use Apple. Coming over to QuickFS, you can see on the home screen you have ROI clearly labeled on the front page, and then if you click onto the following page, you can see the EPS growth along with the revenue growth as well. And this can give you a clear indication about the trend of growth that the company's had, and give you an idea of how strong the business is and how well it's been doing over the past few years. My second tip is understanding the company. Once you've screened some of the numerical data and identified that the company has investment potential, it's a good idea to develop your understanding of the business so you can enhance your knowledge and make a better judgment on whether or not the company is worth investing into or not. There's a few ways that I like to do this. The first one being looking at a 10K report. Now, this is a large legal document that's printed on an annual basis for all major companies. It has a lot of finer, detailed information about a business, such as its risk factors that might hurt the company's growth in terms of sales, revenue, and further development. It outlines the management team's plan for the company and how they plan to grow it into the future, and any legal proceedings or problems that the business has faced, along with many other factors that overall help with developing an understanding of that company. It's quite a large document and it can be a bit daunting when you first start reading it, but the more you read and the more time you spend looking at them, the better you are at picking out the key information and making the process go a bit faster. The second place that I like to look is watching the conference calls for the company. This is essentially where management will have a form of presentation and ability for investors to ask questions about the company, and this gives you an idea of where the management team is planning to go for the business, their integrity, the strengths that they have, and overall are able to provide investors to build confidence that their company is worthwhile holding on to your investment or making an initial investment on that business. Those are the two key places I like to look to really develop my understanding for that company, and I think it really helps building your knowledge about a business before putting your money into it, because it helps with the confidence that you have with where you've placed your money and will help you hold on to that business long term. My third and final tip that I have is paying the correct price for a business. Now, if you pay too much for a company, you can turn a good investment into a bad investment. When it comes to pricing a business, there is an intrinsic value or fair value. This is really what the company is determined to be worth at its core value. In conjunction with that, there is also, of course, overvalued, paying too much for the business than what it's really worth. And then finally, there is undervalued, which is really what you want to be paying less for a company than what it's really worth. This can be also referred to as margin of safety. And margin of safety is typically expressed as a percentage. So for example, if a company, say, was valued at $100 per share, and then it was available to invest in on the stock market at $70, then you would have a margin of safety of 30%. But when it comes to stocks, they're not always priced correctly. They can be priced far above what they're really worth and placed far under what they're really worth. But with the market, in the short term, there's a lot of variability to these prices, but in the very long term, say a 5 to 10 year period, the true price of a company will always be represented, and there will be corrections along the way that will bring the company to its fair price. But as a rule of thumb, when you're making investments, you will not only invest in companies that have at least a 30% margin of safety, so paying at least 30% less for a company than what it's really worth. This is really a great way just to guarantee yourself that you'll make a profit from your investment, because if you're paying 70 cents for something that's really worth $1, it puts you in good stead to make sure that you don't lose money on the investment that you've made. If you want to calculate the company's intrinsic value, a great place to go is simply Wall Street. If you pop in the ticker symbol for the company you're wanting to look at, it will have a pre-done calculation that will tell you what the margin of safety is or what the current share price is in relation to the intrinsic value for that business. So I'll just pop in the ticker symbol for Apple, and we can see that it is currently overvalued. It gives you a number of the percentage of how overvalued or undervalued it is, and this is a great way to see where the company is sitting and whether or not it's a good time to make that investment. Wrapping everything up, the way you make money through investing in stocks is by selecting a strong business that you understand and paying the correct price for it. This is ultimately one of the most tried and true methods that there are for investing, and it's one that I personally use. Thanks for watching. I hope you enjoyed the content and you're feeling more confident in how to make money through investing in stocks. As always, if you want to check out any more future videos or help support the channel, feel free to click the links on screen, and I'll see you guys in the next video.